Are you tired of trying to pick individual stocks and not seeing the results you hoped for? What if I told you there's a simpler, safer way to grow your wealth? Today, I'm going to share a clear, step-by-step guide to building a successful investment portfolio with index funds. Welcome to WealthWave, the channel dedicated to helping you master your financial future. In today's video, we're going to dive deep into why index funds are one of the smartest choices for both beginner and seasoned investors. Not only do they offer diversification and lower risk, but they are also cost-effective, making them ideal for long-term growth. Let's explore how to start building your successful investment portfolio in just a few steps. Step 1. Understanding index funds. First, let's understand what an index fund actually is. An index fund is a type of mutual fund or ETF that aims to replicate the performance of a specific index, like the S&P 500. By doing so, you're essentially investing in hundreds or even thousands of companies at once. This diversification reduces the risk that comes from betting on just a few individual stocks. Index funds follow a passive investment strategy, meaning fund managers don't actively try to beat the market, but rather aim to mirror the market's overall performance. This is key because, over the long term, research has shown that passive strategies tend to outperform active stock picking. Step 2. Decide your financial goals. Before diving into index funds, it's crucial to define your financial goals. Are you investing for retirement, a down payment on a house, or simply to build wealth over time? Your goals will help determine which index funds make the most sense for you. For long-term growth, you might look at stock index funds like the S&P 500. For shorter-term goals, you might want to mix in bond index funds to reduce volatility. Clarify your time horizon, how long you plan to invest, and your risk tolerance. If you're young, you can likely afford to take more risks with stock-heavy portfolios. If you're closer to retirement, a more conservative, balanced approach might be better. Step 3. Choose the right index funds. There are many index funds to choose from, so how do you pick the right ones? Start by looking at large-cap stock indexes, such as the S&P 500, which gives you exposure to the largest U.S. companies. For global diversification, consider international or emerging markets index funds. You can also include bond index funds to cushion your portfolio against market volatility. When selecting an index fund, it's also essential to consider the fund's expense ratio. This is the fee you'll pay annually as a percentage of your investment. Thankfully, index funds generally have low expense ratios, but even a small percentage can add up over time. Lastly, some funds pay dividends, which are another form of return on your investment. Reinvesting these dividends can compound your returns over time, helping your portfolio grow even faster. Step 4. Diversify across sectors and asset classes. Diversification is key to managing risk in your portfolio. Even though index funds are diversified by nature, you can spread your investments across different types of index funds. For example, you might want to hold a U.S. stock index fund, an international stock index fund, and a bond index fund. This approach ensures that you're not too reliant on any one region or asset class for returns. You might also consider sector-specific index funds if you want exposure to particular industries, like technology, healthcare, or real estate. However, be careful not to over-concentrate in any one sector, as this could increase your risk. Step 5. Automate and rebalance your portfolio. One of the biggest advantages of index fund investing is its hands-off approach. Set up automatic contributions each month to dollar-cost average into your portfolio, buying shares regardless of market conditions. This takes the emotion out of investing and ensures you're consistently building your wealth. Additionally, you'll want to rebalance your portfolio at least once a year. Over time, certain funds may outperform others, causing your asset allocation to drift from your target. By rebalancing, you'll maintain the level of risk that aligns with your financial goals. Now that you know the steps, it's time to start building your index fund portfolio today. Don't forget to like and subscribe to WealthWave. In our next videos, we'll be diving deeper into these strategies and showing you how to maximize your returns.